If you spend more than 10 minutes on financial feeds these days, you know exactly what pitch I'm talking about. A confident guru leans into the camera and tells you, hey, the rich don't use banks, they use life insurance. They buy a policy, overfund it, and literally borrow against their own money tax-free. It's called infinite banking, and frankly, it sounds incredibly seductive. It feels like you've just been handed the VIP keys to capitalism, right? Like you could just act as your own sovereign financial entity. But is it really the wealth-building cheat code it claims to be? Welcome back to Zach Wealth Files. I'm Zach. Remember, we talk frameworks here, not personalized advice, so always run things by a licensed professional. Today, we're cutting through the hype and breaking down the actual facts behind the marketing.
I want to start right off the bat with a number that these gurus conveniently leave out of their pitch: 80 to 110%. That right there is the typical first-year commission an insurance agent makes off your Index Universal Life or IUL premium. Think about that for a second. If you pay $20,000 into your brand new quote-unquote family bank in year one, the insurance company immediately takes between $16,000 and $22,000 and hands it straight to the agent who sold it to you. You are instantly down 90% on your money. By the end of this explainer, you're going to know the dark math behind infinite banking, and I'll give you the exact 3-step legal framework you can use to build a real family bank without paying a single dime to an insurance agent. To really understand the trap here, you have to understand the specific product being pushed. Your modern financial guru is usually pitching an indexed universal life policy, or an IUL. Basically, it's a permanent life insurance policy where your cash value growth is tied to a stock market index, something like the S&P 500. Now, the pitch is always the same. Hey, if the market goes up, you get the gains. If it crashes, you have a 0% floor, so you never lose money. I mean, it sounds amazing, right? Upside with zero downside. But here's the part most people get completely wrong about that 0% floor. You don't actually own the index. The insurance company takes your premium, takes out their massive commissions and administrative fees, and uses the rest to buy call options.
Think of market returns like a giant pizza. Let's say the market bakes a massive 22-slice pizza in a really great year. But your IUL contract has what's called a cap rate of, say, 10%. So even though the market delivered 22 slices, you are legally capped at getting 10. The insurance company? They just eat the other 12 slices. It's how the house always wins. And what about that famous 0% floor? Well, if the market is flat, your index return is 0. But you still have to pay the internal cost of insurance, which, by the way, scales exponentially as you get older. If your internal fees are 4%, your so-called 0% floor actually results in a negative 4% return. It just cannibalizes your cash value.
Now, the core pitch is that you can borrow against your cash value tax-free. And yes, technically that's true, but guys, it is not free money. There's this thing called negative arbitrage. The insurance company might charge you 5 to 7% interest on that loan, while your underlying cash value might only be credited at 4 to 5%. Do the math fair. You are literally paying the insurance company more than your money is earning. And it gets worse. If your policy lapses, maybe you hit a business downturn and can't make the premiums, the IRS steps in and considers that outstanding loan a distribution. You'll instantly owe ordinary income tax on phantom income that you've already spent. It is a massive, massive tax bomb.
So what's the alternative here? Well, a very common mathematically grounded approach is simply to buy term and invest the difference. Let's look at a 30-year simulation. If you put $20,000 a year into an IUL, once you factor in all those caps and fees, historical internal rates of return really just hover between 3 and 5%. But if you buy a level term life policy for $1,500, which gets you the exact same death benefit, and you invest the remaining $18,500 in a low-cost S&P 500 index fund, history shows an average 9 to 10% return. The index fund strategy is just massively larger, it's completely liquid, and if you pass away, your heirs get the portfolio with a step-up in basis, which means zero capital gains tax for them.
The ultra-wealthy use the Internal Revenue Code, and they bypass commercial banks completely. You see, the IRS sets a minimum interest rate called the Applicable Federal Rate, or AFR, to avoid gift taxes. So let's say a parent lends their child $1 million to buy a duplex. Now, a normal bank would probably charge that kid 8%, but instead, the parent drafts a formal promissory note at the IRS AFR. Let's call it 4.5%. The child buys the duplex, it yields 8%, the child pays the parent the 4.5% interest and keeps that 3.5% arbitrage for themselves. Both the spread and the interest stay entirely inside the family bloodline. No banks, no bloated insurance commissions. That is how a real family bank operates.
And to formalize all of this, the wealthy utilize a Family LLC. It works like this. The parents hold 1% as managing members. That means they control 100% of the decisions. The children hold 99% as non-managing members, so they have zero voting control. This legal structure does two incredible things. First, asset protection. If a child gets sued or goes through a bad divorce, creditors cannot seize control of the LLC's assets because the child literally has no voting rights. Second, it creates huge valuation discounts. The IRS allows discounts for lack of marketability and control. That means you could legally transfer $10 million into the LLC, but the IRS might only value it at $7 million for estate taxes. You legally erase millions from your taxable estate. It's brilliant.
That is totally fine. The principles of the family bank scale down beautifully for middle-class families. Here's a concrete 3-step action plan you can use this week. Step 1. Spend $1,500 to $3,000 with an estate attorney to set up a revocable living trust. This transfers your assets out of your personal name, completely bypassing the very public, very expensive probate court when you pass. Step 2. The HELOC family loan. If your kid needs a car, don't let them go finance it at a dealership for 11%. Draw from your home equity line of credit at 7% and lend it to your child using a promissory note. They pay you the interest, keeping that money in your family's ecosystem. And step 3. If your child has any legitimate earned income, open a custodial Roth IRA and seed it with up to $7,000 a year. Let that compound for 50 years, and you've just created hundreds of thousands in completely tax-free generational wealth.
These legal structures only work if you actually respect the corporate formalities. If you set up an LLC, but then you use its bank account to go buy your personal groceries, a judge is going to do what's called piercing the corporate veil. They'll declare your LLC a total sham, they'll strip away all your asset protection, and they'll allow creditors to seize everything. Treating your family entity with strict corporate discipline is completely non-negotiable. You must have a distinct EIN, you need completely separate bank accounts, you file separate tax returns, and there can be absolutely zero commingling of personal and family bank funds. Period.
Look, the financial services industry wants you to believe that wealth preservation requires these complex, proprietary products that only they can sell you. They wrap incredibly basic concepts in fancy marketing terms just so they can charge you a massive premium. But I want you to remember this. True generational wealth is built by understanding the legal architecture of ownership, not by buying retail illusions. It's built by separating control from ownership and keeping the friction of taxes and bank interest as far away from your family's capital as legally possible.
You really don't need to be a billionaire to build a family bank. You just need some clarity and the right structure. If this explainer saved you from a massive insurance mistake today, or maybe inspired you to finally go set up that living trust, then it did its job. But I want to hear from you. Have you ever been pitched an IUL or an infinite banking policy by a friend or a financial agent? How did you handle it? Drop a comment below. I literally read every single one. And hey, subscribe to the channel to keep building your financial framework. Remember, the goal isn't to buy the bank's products. The goal is to become the bank. I'll see you in the next explainer.